of topical conversations related to discovery, related to investing, related to industry, etc. And please do give us some ideas or some thoughts of future topics that you would like to hear. We do it for two reasons: education, empowerment, sharing of knowledge, but at the same time for content for our website. So please do go and have a look at Candid 2020. That's the name of the business. And all of these recordings go online and are available. If you do not want to be online, please don't ask any questions, but we will be holding questions at the end of the session. If there is something in the interim, please feel free to stop us and ask a question, but knowing that it will be recorded. So thank you for the time. Thank you for the opportunity. Thank you for my team. We have a wonderful team around us. We have Estelle sitting manning the camera and the computer at the back. Estelle is our health expert, looks after all of our employee benefits, group risk, pension fund, provident funds, group medical aid, and wills, and just literally make sure that all of our clients feel special. And last week she got the most incredible bunch of flowers from somebody saying thank you for a job well done. So thank you, Estelle, in the background there. We have Lisa right in the back, who, I don't know, she just amazes me each and every day. What she does on the invest and on the life side, making sure that all the information is gathered and correct. And yeah, Lisa, thank you. You do an incredible job. We appreciate you, Lesedi. Make sure that all of our emails get sent, and just all the general administration in the office grown leaps and bounds, and also an integral part of our business. Each and every person is. Lorato, make sure that all of our tea, coffee, glasses and everything are all filled and sorted. And then, of course, I have Lindsay, who is an assistant financial advisor, CFP as an I. So I'm not sure why there is an assistant in the name. She's a financial advisor. I'm working with her in the practice. And Skeen looks after all of our insurance. Lindsay, Skeen, integral for client contact and making sure that when I'm busy and on to things, that everything gets sorted. So really appreciated there. Skeen has done all the cooking. So I think that is an absolute yeah. Skeen, you have some fans.
Yeah.
But it wouldn't be possible without each and every one of you who support us and make our business possible. So we do appreciate it. We're going to dive in quite quickly. Tonight's topic is investing. Discovery have recently launched a couple of innovative products that one of particular interest that I wanted to go through and share with you. But just to give you an indication of how and where investing actually comes into play within our practice. As I've said, Candid 2020 is the company. And within that, as a tied agency with Discovery, we have solutions out of the Discovery stable that offers mitigation against risk, creation of wealth, which is exactly what we at Candid 2020 stand for, creating and protecting wealth. On the creating side, we have Invest, which we're going to dive into in a big way this evening. On the protection, we have the risk side, linked in with short-term insurance, linked in with medical aid, and then obviously the bank on the investment side there too. Our website is available. Social media, please go and follow us. Candid 2020 on Instagram, Facebook, LinkedIn, and we'd love to have some feedback and some thoughts in terms of that. Diving into the invest side, pre-retirement planning for all of you currently in the workforce, though that is the space that we look at. What are we doing before we retire? We then look at post-retirement, and we divide them into two areas because there's a different solution for each section of your life stages. There could be a transformation in pre to post where you're still working, potentially retiring from some investments, transforming, because what is retirement? Thembakazi has recently retired last month. And I think she's probably in a whirlwind of what does it actually mean to her. Are you still working? Oh, well, okay.
Is she ever going to stop? I don't know.
So we do divide it into the pre and the post. We have flexible investments, which is by nature of the term flexible. And then we have endowments. And local, offshore. So the full spectrum of investing that is available out there in the market with your wealth managers, etc., are offered by our financial planning practice. And tonight we're going to be talking on the investment side of it. Anybody who's worked with me in the past will know my Investing 101. You've got a copy on your chair, and it's something that we're going to be referring to. Don't ask me why Lindsay cut it in half and reduced it. I did tell her it's late at night. Save paper, save paper.
Save the pen.
It's late at night and the eyesight is starting to fade. But it's something that each and every single conversation that I have with a client, a prospective client coming into the practice, an existing client, somebody who's been with us for 15, 20, how many years, Thembakazi, he sees this and we use it as our reference point. And I'm going to just go over it very quickly to just give us an indication and set a foundation for investments. I always say, if we leave our money in our check account, we're not earning interest. We're not earning any money. It's there for us to transact with. We can then look to start to move it into savings accounts. And each and every bank has a different term for it: a money market, a fixed deposit, a call account, a flexi saver. It's all literally just a term to have savings of a certain amount for a certain period of time, typically invested in the bank's model, cash, giving an interest as an income or an interest-bearing return for money in a call account. As soon as we say, and what are those call accounts returning on average, Lindsay, what would we say?
Starting probably from about 6%. It's if you have a lot of capital, maybe in one, you're probably getting about 8.5% max, I'd say. I wouldn't really see anything of real return being more than 9%, 8.5%, 9%.
We often hear conversations of 10, but we've got to be very careful on that, because that's perhaps at the end of the term as opposed to a nominal interest rate. So typically we're looking at about an 8-9% is where we're looking at. What's interest? What's inflation? And I suppose we could go around the room and argue what that could be. Inflation rate, what would we say that is on average?
Probably around, depends on what type of inflation, but normally I'd say maybe around 6%.
CPI typically sits at the 5-6% rate. We could argue that education, medical costs far exceed that. And if we have inflation sitting in excess of 6%, we have a return of 7 or 8%. Is our capital typically growing, or are we literally just treading water with inflation? So sometimes people will say, investors will say, what can I do other than a bank account? And that's where we would then start to go to use an asset manager. And you'll see in the top right-hand corner of the screen there, we've just listed a couple: Allan Gray, Coronation, Investec, who've rebranded as 91. So there's many. There's in fact over 500 asset managers in the country that we can choose from. But when you start to engage with an asset manager, typically you're going to then be asked, what asset class do you want to be investing in? And our first asset class that we would consider would be cash, a money market fund. It's not an account, it's a fund where you're now not investing particularly in one institution, but the asset manager may be invested in multiple, giving us a potential return higher than what we could be obtaining in the bank. Our next asset class that we would look at is bonds. Those are typically government bonds, institutional bonds. Now you can see we're going up the risk rating, but we're also going up potentially the return. Those should match risk and return. Sometimes they do come out of balance, but as we go up the risk and we go into a bond, a government bond, an institutional bond is typically where funds would be made available to an investor, to the government, to an institution to go and do big projects where they would give a guarantee of a percentage over a period of time, potentially 10% over 10 years, etc. Our next asset class that we'd look at would be property. And typically this is where assets or investments would be put into an asset manager and then lent out to a property developer for shopping centres, office parks, etc., where there would be potentially capital appreciation in those assets, and also hopefully some rental income from the people that would be investing in the property portfolio. And our last asset class that we look at generally is equities. This is where the investments are placed on the stock exchange in various equity models, low risk perhaps being your financial institutions, your banks, etc. High risk being potentially newer companies coming and just listing on stock exchanges, etc. And you'll see on the far off corner, we have offshore, which is then offshore bonds, cash, property, equities. And we have that as our base and our foundation. We use this diagram to just set the standard and the mode and for our talk, because when we're investing, we're then going to look at what wrappers go around it. And you'll see I have 3 wrappers there, the first being a flexible investment, which could be known as like a unit trust type portfolio. It's flexible in nature, and with it being flexible in nature, that means that the individual holds the investment. The entity holds the investment. So if you're investing as a company, the company would hold the investment. If you're investing as an individual, the individual would hold it. And they would be responsible for all of the tax reporting. They would need to submit to SARS at the end of the tax year their IT3A with their tax that they'd earned from the bank, from the financial institution. It would be added to their taxable income, and they would then be responsible for tax. I'm simplifying it. There are other rules that come into play, and obviously, dependent on what the topic of discussion is, we then go down those avenues. But what I want you to understand is a flexible investment is exactly that, but making the tax reporting the responsibility of the entity or the individual holding it. High tax individuals look to seek alternative options, and that's when an endowment wrapper comes into play. And an endowment wrapper is governed by legislation. Tax is payable, but it's payable at the corporate rate of 30%. So anybody in a 45% tax bracket may have a benefit for being in an endowment wrapper because the tax on interest would be at 30%. However, if we're in an endowment wrapper, in more instances, or we would then find that we're in equities and dividends, which then results in a 12.5% capital gains. Still a lower rate than what you'd be paying in personal capacity. Our last wrapper that we look at is our retirement savings, pension provident funds, and there is no tax obligations on growth within those investments, within those wrappers, giving individuals an opportunity to be saving long term with some perks and some benefits that are really attractive, and I'd argue that shouldn't be overlooked as part of a fully comprehensive portfolio. So with that in mind, we're going to go into our discovery model.
Being the shared value model. So in previous talks, we would have always brought up the shared value model. It's something that's brought into every single company that Discovery has, be it the medical aid, through Vitality or Life. Shared value is creating a healthier, better nation, encouraging good behaviors. So that means better environment for the people, for the clients, for community, being able to pay cashbacks, benefits, boosts to clients, but also benefiting the company. And that's effectively the cycle of the shared value model. With regards to Discovery Invest, there's a lot of benefits in terms of integration with Discovery, which I think Tammy is going to highlight for us.
Tammy is one of our invest specialists. So we financial advisors with Discovery represent each and every product line. And obviously there's a lot of innovation, there's a lot of changes that come through from time to time. We stay on top of that. However, we have an incredible support team behind us that support and give us additional information. Tammy is our invest specialist, and any of you who have worked with me with investments have in all likelihood met her, and she shares the shared value in a very good way. Let's hear from Tammy. What do you believe the Discovery shared value approach is all about? Please share that information with us.
Thank you, Shirls. So essentially, if we look at what Discovery's core focus is, it's in terms of enhancing and protecting clients' lives. And that focus and that drive and value system is driven throughout each of the product lines that Discovery holds, especially within Invest. We'll also remember Discovery wants to be a force for social good. So in terms of being a force for social good, we look at what are the gaps currently sitting within the investment field and for clients. And specifically when it comes to retirement and offshore planning or any type of investments, what we've noticed that clients don't save enough and they don't save for long enough either. Thus, they don't get to their goals that they require. So what we do is we provide an incentive exactly through like the Vitality programs. The longer you save, the more incentives we provide. And obviously, from just a pure economic point of view, understand that the more money you generate, the more fees an administrator can earn, and we take those fees and give it back through to the clients. That's how we create the shared value within the Invest system.
So essentially, you're saying somebody who's going to be investing in the long term, Discovery are making money from the administration fees of that. The more money they make, the more of the opportunity there is to give back to the investors. Am I understanding it correctly?
That is 100%, because they've reached a plateau where we've covered all the costs in terms of, think about it, salaries and jobs and overheads, and now you're making that excess. That excess goes back. Remember, as part of Adrian Gore's always said, unlike most other companies, like a Liberty, where any extra dividends they earn, they can, either go back to clients, shareholders. They've done bought investment portfolios. Other companies have even back to their shareholders. Adrian is very much, don't go back to shareholders. It goes back to the clients of Discovery and within this model, this system.
What do you think is the most interesting added value, shared value approach? Which one of the products is your most innovative or the best one that you think is available?
I think in terms of our lump sum pre-retirement products, most definitely we have an edge, and also from our global point of view, where we provide and we think about what clients may need in a global environment in terms of accessibility to the funds. And we've created flexibility in terms of having that access, but also being very cognizant of some taxes and trying to lower that for clients.
Yeah, I think I couldn't agree with you more that annuity, pension funds, preservation funds, retirement annuities that are in waiting for retirement, that boost that's given is just unbelievable in my opinion. I agree there. I think mine, Lindsay, Tammy, mine would be the living annuity. That up to 50% boost on your monthly income. I mean, it almost sounds too good to be true.
And added possibly to that, the fact that made a change to the living annuities, noticing that there's very much a need that, yes, we still need living annuities and the more almost legacy type fixed annuities within the environment you've had, particularly from the onset of COVID. So, but living, you need a higher income in the beginning of your life, and then later on you need that security, and it's very hard to get that up front. With Discovery, obviously, apart from we give you those income boosts, obviously now help you make that living annuity last longer, but we also give you the opportunity to pre-buy a guaranteed income that will kick in 15 years after the investment of your living annuity. So you have peace of mind knowing 15 years later, you've got this guaranteed income and it's there for life till the day you die.
Thanks, Tammy, for raising that. That's exactly what we want to be discussing tonight. So thank you for raising it. Appreciate your time. And as always, your information, couldn't do it without you. So thank you for the support. Appreciate it.
Pleasure, Shirley. Thank you. Bye.
So I think what we'd like to do now is potentially go on to that living annuity and perhaps just take a minute out to just understand what happens. And pre-retirement, I did want a whiteboard and I'm going, I wish I had it. Those of you who work with me know that I almost can't talk if I don't draw. As soon as I start drawing, the pictures flow and then I can actually enhance and build on it. But pre-retirement, you're saving in a pension fund, you're saving in retirement, you may be buying investments, etc. We're focusing tonight on the retirement annuities, the pension funds. You may have left an employer, preserved it, That's all funds that are sitting and building up for that day when you want to retire from them, and you're now going to expect that capital to supplement any other income or be the only source of income, depending on how you've structured it over your lifetime. We are talking about post-retirement here, where we've now taken this retirement annuity pension fund, we've matured from it, and we're now going to start to draw an income. And that is always such a daunting task for an individual to choose. How much income do they draw down? How do they invest it? And typically we have two types of annuities. We have what we call a living annuity, and we have something that's called a fixed annuity. A living annuity is one that gives you the opportunity to change your level of income on anniversary each and every year. You can draw down anything from 2.5% of the capital to a maximum of 17.5% of the capital per annum, paid monthly, paid quarterly, paid every 6 months, or paid annually. Traditionally, people take it every month, and it's dependent then on the capital that's invested, right? We have a return based on where that investment may be. And I'm going to use, for example, an 8% return. If we've got an 8% return and we're drawing down 2.5%, we can appreciate that our capital is going to grow, right? If, however, income determines that we need to have a 12% drawdown and we're only getting an 8% return, it stands to reason that we're going to be eating into our capital and it may run out. And if only we all had that crystal ball of how long are we going to live? Because if we knew that, choices and options would be very easy. We know that with longevity, people are living longer.
There's a really nice stat there. It might be a little bit small for you, but individuals in Japan, it's in that column, it's on the furthest right-hand side, how their life expectancy compares to the purple, which is the capital to survive that life expectancy. So we are really in a time of people living much longer, but not having sufficient capital to retire from.
And what some people do is potentially buy into what we call a fixed annuity. And a fixed annuity, a guaranteed annuity, a life annuity, gives you an opportunity to draw down a percentage that the insurance company is prepared to offer that changes from time to time. And based on your age, based on your gender, they will then determine using their life statistics of what that rate would be. And they give you the peace of mind and guarantee that they will pay it for a number of years, 10 years, 15, 5, depending on what you're looking to buy. And if you pass away before then, that the remaining period will be paid out to your beneficiaries. However, when you pass after year 16, then that capital is gone because you were taking the chances with the insurance company. So those two are the traditional that we have, the living and the fixed. And what happens now is that Discovery have changed and introduced a first time ever lifespan retirement plan.
Yeah.
Some innovations don't just improve lives, they redefine them. What if one bold idea could secure income for life and help you enjoy it in good health? Introducing the Lifespan Linked Income Plan, the first retirement solution designed to deliver maximum income, flexibility, and longevity protection. With an innovative incentive that offers income boosts of up to 50%, healthy financial and lifestyle decisions are turned into tangible gains. It's a solution that guarantees income for life, with built-in longevity protection so that you will never have to worry about outliving your retirement savings. Plus, wealth can be preserved and fully transferred to beneficiaries, ensuring an effortless transition to the next generation. Welcome to the Retirement Income Solution, designed for the future. Discovery Invest, the future of investing, now.
So what they've done is they've taken the best of both and combined them and brought them in together. And what it does is it gives you in your initial years of retiring the opportunity to draw down an income that you choose is suitable based on the capital that you have, based on your other income that you may be having and your income needs. We would encourage drawing down as low a percentage as possible, maximizing one of those boosts that we mentioned of an up to 50% boost on the income that you're drawing down, capped at 100,000 Rand per annum. What that means is that if you are drawing down your capital at 2.5%, and that payment is 10,000 Rand, for example, Discovery will use from their funds an extra 5,000 Rand to boost your income based on that shared value approach. It happens each and every day. Our clients are participating on it, utilizing the Vitality to actually boost their income whilst they're in retirement. And I often say to my clients, don't ask me why, just get to Vitality Diamond, because the boosts, the benefits, and everything that comes with it are just exponential over the entire packages of Discovery, the living annuity being that. So we're drawing down a low amount, we're getting a boost. And what Discovery have said is that from that first day, we will take a portion of your capital and actually buy a guarantee that in 15 years' time, you will receive a guaranteed annuity on top of the income that you're drawing down, giving you the peace of mind that if longevity is in your genes, and we hope and pray it is, that you have the guarantee of income when you need it most. So we've drawn up a little bit of a case study to try and explain it. We have a client particularly where we use this as an example. He currently, 66 years old, has a living annuity with a competitor. He's drawing down 2.5%. It's not his only income. He needed to retire. He needed his funds. He's supplementing it. He can choose each and every year to change it, but right now he's drawing down 2.5%. His capital is sitting at 9.8 million in his annuity, his living annuity that he has with the competitor. His income currently is sitting at 20,400 Rand. Moving his funds into the Discovery stable, he continues to draw down his 2.5%. However, he's going to qualify based on a Gold Vitality status, and with the fund structure that we've used, he's going to qualify for a 35% boost. That's an additional 7,000 Rand that he's not getting today. 27,400 versus the 20,000, his capital withdrawal is still sitting at the 2.5%. In the background, Discovery will take 6,000 Rand and invest that for a guaranteed annuity that will pay out 15 years down the line. So 6,000 Rand, and that percentage is determined on the value of your capital. That percentage is invested on side, ready for a guaranteed annuity to pay out in 15 years. And in 15 years' time, when he turns 81, he will still be drawing down his percentage. It may have changed to 5. It may have even gone to 7. But at 81, a new guaranteed annuity in today's value of 26,000 Rand will be paid out. That 26,000 in today's value at 81 will be 54,000. So he's given that guarantee of a Rand value at future value terms. And that 26,000 in today's value will continue for as long as he lives. His capital will remain intact in the living annuity, giving him the opportunity to start to draw down more, potentially when he hits an age where potentially there could be higher medical costs, seeking care for new types of caring, home facilities, etc. So yes.
Sorry, the Gold Vitality status. A silly question. Is that your health vitality?
Yes.
Vitality.
Health vitality. And we've assumed gold because it's achievable. Diamond, you do have to work for it. You do have to make sure that you're doing the activity. You do have to do some of the things. Gold is extremely achievable, and that's why we've used gold in this particular example, in this particular scenario. So this, yes, 2 questions.
Tembakazi.
So the 26,000, is it monthly or is it just?
Monthly,
Monthly.
for as long as you live, for the remainder of your life.
So it would be 26,000 plus the amount you're drawing down.
Yes.
Plus whatever's left in the living annuity that you're drawing down from.
This
This is retirement.
Yeah.
Guy.
2 questions on that. That gold vitality status, that would mean you would need to continue with gold vitality status until the end, whether it's feasible at 80.
Maybe you've got vitality 65 plus. So the matrix has changed. Meg can attest.
We won't share her age.
Yeah, we won't show age, but you're on diamond, are you not? Yeah.
I think, Guy, in answer to that question, Skeen's father, 89 years old, is on diamond status on vitality. So yes, there are a lot of conditions and questions, you know, how active can you be? How physically active can you be? And Lindsay alludes to the point that at 65, the goals and the targets and the ways to earn points become more and easier. So for example, we will know that we need to do 10,000 steps to get 100 points. When you're over 65, it would be 7,500. So they do accommodate and change. We do also have the vitality memory that kicks in as well. We've worked on a 35.8%. Even on the absolute base of blue, there is still a boost on your income. So you are still given that opportunity moving to bronze, to silver, to gold. But I can assure you, we have a lot of elderly clients that are diamond members.
Okay. Then that's 6,000 rand. Is that coming out of the 27,000 or is that separate?
Separate.
It's coming up from the capital.
Coming from your capital. So the percentages here in this instance is 0.75% is coming out, going into your guaranteed purchase of an annuity.
Oh, okay.
Okay, so 2.5 is being paid to you monthly. You're getting the boost based on your vitality status. And an additional, in this instance, 0.75% is being set aside for that guaranteed annuity in 15 years.
And that's variable, the 0.75?
No, it's a fixed amount built into the package and based on the capital that you have. If you were to pass away prior to the 15-year and the guarantee coming into play, any capital that had been set aside will be made available and paid to your beneficiaries as if it had remained in the living annuity. So certainly giving you the best of both worlds. We have been a market contender, and we speak ourselves in terms of the clients that we have moved over from living annuities into the discovery space with that boost. This now just puts it on steroids, in my opinion, giving you the peace of mind that longevity, when and if that happens, is going to be built in with some protection.
Do joint annuities?
Do we do?
Joint.
Joint, absolutely. Not in this model, but we do joint annuities, absolutely. Joint annuities, for those in the audience that don't perhaps know, is that I would buy an annuity for me with a guarantee of 10 or 15 years, but I could put my spouse on as a joint annuitant. And in the event of my death, the annuity would continue and pay to them either at 100% or at a percentage, depending on what the needs are. So absolutely, a lot of flexibility and availability of certain products within the annuity space. But this one of that guarantee, just certainly, in my opinion, going to be a game changer and revolutionizing the way that we look at annuities, giving you peace of mind for the future.
And just to add, this is just launched. So it's only come into effect now at the end of June.
So retirement annuity is building up pre-retirement. At retirement age, 55, 60, 65, when you retire from your company, 80, You then buy a living annuity, a fixed annuity from your compulsory money. Not now. You're too young. Sorry, Mbali, you're going to need to wait a number of years. The idea and why we have you all listening here today is that we all work in a network of people, family, friends, and we then encourage you to know as much as possible. So when people are saying we're struggling, you can say, have you thought of this? Have you spoken to Candid 2020, Shirley Lindsay? Have you looked at options that's there? And I think it's also important for us to start to educate and empower ourselves so that when it comes time to making decisions, we're not only forced with what do we do in retirement, but we've got an idea of where we can actually start to plan. We're here to hold your hand, and that's exactly why we're empowering you this evening and sharing some information. Moving on from our annuity is a second new enhancement, and I want to just take a step back and go back into the investment space. Clear your mind of annuities. Clear your mind of pre and post. Now we're looking at just investing. When we're investing, you can understand that we have various wrappers, the flexible, the endowment, the retirement. And then we have those funds that are made up of asset classes and asset managers, right? One of the funds that's just been recently launched, it's new, it's brand new.
So I think something that I'll just add in there is there's a growing need of private investment. So a lot of you probably have heard of private equity, and that is missing from our graph at the moment. But Discovery is launching a fund to target that market. And I think let's hear what Discovery has to say first.
From the iconic Wall Street to today's digital trading platforms, the stock market has long stood as a symbol of consistent financial growth and opportunity. But the world of finance is changing. While public companies remain essential, over the past 30 years, private markets have expanded rapidly, now accounting for 14% of global GDP and projected to grow by nearly 50% by 2029. This shift is creating new and exciting opportunities for diversification and returns. Introducing the Cogence Diversified Markets Portfolio. Leveraging BlackRock's multi-billion-dollar private markets platform, it offers access to a full spectrum of public and private markets, sectors, geographies, and asset classes. The Cogence Diversified Markets Portfolio is redefining diversification, expanding your access and elevating your investment portfolio.
We're not going to spend too much time on it, Lindsay. It's a Thursday evening at the end of financial year end month, but it's there.
Yes, so Cogence is a discretionary fund management company that Discovery has created and partnered with BlackRock. And this fund is a new fund. It's quite a niche fund. It's not something we might recommend to everybody because it is on the riskier side, but it does allow someone with a boutique or a niche portfolio to have that private equity exposure. It's a small portion of the fund, well, not a small portion, it's a portion of the fund. And that is just to bridge any gaps that you feel you might have in your portfolio that you might not have access to a private market. Fund composition, I'd say it's possibly about a quarter of the fund that is in that private market, looking at private credit, private equity, and it does have an investment time horizon of more than 5 years. So on the riskier side of things, but possibly worth considering adding. Like we've mentioned, this is a brand new fund. It is only launched now at the end of June. So sometimes we're a little bit hesitant and we kind of wanting to see how things go for a while, but definitely something to have in the back of mind when considering the structuring of your portfolio. And we will bring it to your attention if we feel that your portfolio is missing something like this. I think that's safe to say.
Absolutely.
Sorry, I noticed it's quite a large portion in SA equity.
Yes, so it's based on our local endowment platform. So it does have the global private equity realm, but it is mostly a South African based fund.
Yes.
Take it down to like a simplified dummy version. Okay, what do you mean by access to private markets?
So private markets are private companies. Usually we invest with I'll even go to the investing 101 again, since it's there. We've got our equities there at the far right of our return. Equities are publicly listed company stocks, company shares. Private equity are investors looking for your smaller private companies that are not listed, not publicly listed. So they're still a private company. Let's say your company, someone comes up to you and says, I want to invest in your company. I see potential growth. And that is the private market that we're talking about. Part of it in a very simplified version. Does that make
I
sense?
think you've just given Zoe a very good idea.
Yeah, so it's open for investors, everyone.
No,
So BlackRock is the management. They manage the fund. Yeah, so we partner with them in terms of the fund management.
they would be establishing
Yeah.
which private equity partners would be included in that fund. They're certainly listed.
Yeah.
If we take a step back and go back into that space, right? Remember, we have our endowments. Within our endowments, we've got those funds, and there is a fund that's been available for a bit of time now, the Discovery Capital 200, 300. It's a tranche. It's a structured product that comes available periodically. It's available now. It opened towards the middle of June, and it will close on the
16th of July.
So any funds being invested, and this particular fund has a tranche date. It's a 5-year term. It gives you the opportunity on a start date of a number. And if there is a positive return, you have the opportunity of doubling your capital, less fees at that point in time. So I think
The end of the
let's,
5 years.
at the end
Yeah.
of the 5
Yeah.
years, let's hear again from Discovery.
Of Discovery Invest's latest limited offer with the Discovery Capital 200-300 Plus. Get 200% of your capital back after 5 years, provided the underlying portfolio of global shares delivers a minimum of 0% growth. Yes, you heard that right, 0. As long as the portfolio of global shares does not deliver a negative return over the next 5 years, your investment will provide 200% of your capital back. There's more. If the portfolio achieves a cumulative growth of 40% or more over the next 5 years, the Discovery Capital 200-300 Plus will provide 300% of your initial investment. You will also benefit from unlimited upside potential should the portfolio perform above these levels. Discovery will provide some limited downside protection unless the portfolio falls by more than 30% within the 5 years. Discovery Invest, the future of investing, now.
And I think on that point, I asked Tammy a little bit earlier what her thoughts were. Tammy, the CAP 200 certainly sounds like a fund that is an option for a diversified portfolio. Please explain to us a little bit about the stocks that the fund would be tracking. I know we have a start date. We have an end date, and that's when they'll be predicting the potential of the up or the down of that investment. What stocks are they tracking? How is it structured?
All right, so essentially, Shirley, what we've gone and done is we've chosen 20 listed stocks. And with those 20 listed stocks, we've got a 70% exposure towards the European markets and a 30% exposure to the US markets. We put this into pretty much a little basket into a basket, and we call it a share basket, and that's the basket we're going to track. So from the start date, so the strike date for this fund is the 30th of July, but obviously our closing date is the 16th. So from the 30th of July for the next 5 years till July 2030, we'll be tracking the fund. Then with the 5 years, all we need to see is has this global basket of stocks and shares grown, been flat or positive, and then the clients will get a double. We then provide a double up return to the clients. Should it do more than 40% over the 5-year period, cumulatively, then instead of getting a double up, we'll move up to 3 times. I mean, you've got now that diversification from a global point of view. You can use it within a current portfolio, should you wish to. So remembering that the minimum is 100,000 Rand. So you need to have that, and it's a lump sum investment. It's-
I think it's incredible actually that you could take an existing portfolio, an existing endowment, for example, and take some of those funds and transfer it into the CAP 200. And I love that flexibility and that option to choose. So an incredible product. I certainly think it should form part of a portfolio.
Yes, and you've got the capital protection. So at least you're taking risk in a global market with equities with some protection involved.
Great, thank you.
Yeah.
I think you may ask why I share this with you this evening, and it's important to know that your existing funds in an endowment wrapper can be switched into this fund if it were a fund choice that you'd be interested in. So you don't need to, if you had an investment of 500,000 Rand, you don't need to transfer the entire 500,000. You literally may take 100,000 of that 500, maintain it in that endowment wrapper, and just simply switch it into this fund so that you have the opportunity for that portion of capital guarantee and doubling, tripling. I think what's interesting is there have been a number, we didn't have the number at hand in preparing for this.
Tammy did say 19 tranches so far that we've had since launching them.
And we've had one where we had a negative return. And that was the tranche that actually matured in the week of COVID hitting. So understandably, on that strike date of the end date, there was a negative. All of the investors had their capital returned less fees. However, that is the only tranche that has not had a double up. And the one that has recently just matured has had, if it had the 300 option, the 300 is relatively new, would have had a triple up on
We
it.
got to about 205% return.
Let me ask. So during the one that ended during the COVID tranche, what percentage did they get?
100% of their capital back. So if they had invested 100, less fees of 5,000, they would have got the 100 less the 5,000 back. That's the beauty of it. The capital is secured.
Just to go back to the list of companies there.
Sorry.
Okay.
This isn't the extensive list, but just certainly the highlights of the companies. You had a question, Zoe?
Yeah, it's probably not a really dumb question.
No question.
Can you take it from your retirement annuity?
No. No, this needs to be in an endowment wrapper, unfortunately.
And she said 100,000.
100,000 minimum.
And maximum?
How much you have in your pocket?
Until the tranche is filled.
Yeah, so there is limited availability in the tranches.
So what they do is they're taking everybody's funds. So they will pool it all together. And on the strike date, that's the funds that are in. They then invest in the background and give you the protection and the guarantee. So you'd have a number of investors in this particular tranche. Your 100, 300, 500 may be part of that tranche. And that's why the limit is to the tranche capital limit that they have exposure for.
So it could get filled up before the 16th.
Absolutely.
Yeah.
Right.
Absolutely.
Sorry, the percentage allocation? 70-30? So it's 70.
Europe and 30 the US.
Just looks strange. You know, look at 30 ING, Mercedes, UBS.
And I'm also thinking it's not 30 Europe, 70 US.
No, there's something else there.
Yeah.
Because I mean, all the NL, majority of European companies,
Mm.
so they're
Oh, yeah.
not so BNI, they're all European. And even the other 30% that sounds Europe on GE,
Mm.
Mercedes. So I don't know what to speak.
Yeah, we can verify that. Rachel, this is but Tammy did say, and I recall thinking to myself, 30% in the US. I wonder if that was strategic with where we are in the world crisis at the moment.
How was the share portfolio chosen?
I have no idea, Zoe. I'm not quite
I
sure.
mean, I would assume it's the fund managers in charge would have done their research on stocks that they feel are going to be best performing over the next 5 years, just intuitively.
You know, the reality is that it's the 19th tranche. They're looking to continue these tranches, so they're choosing and selecting companies that they believe would be giving us a positive return potentially as they would do.
So
I
it's,
think it's not a continental split. I think it's a sector split.
Yeah, I think so too.
Yeah,
In this instance, yeah.
yeah, I think it's a sector.
is the intention to launch this every 2 months? Because there was one 2 months ago.
So it's not sporadic and sort of every 2 months. It would typically be in terms of where their capacity is, what their feeling is. There's no hard fast.
Sometimes once a year, it just
Yeah.
depends.
But quite interesting to be able to potentially go into various tranches and not necessarily hold all of your capital in one tranche, which I think is where your mindset may be going there.
And what about the management fees? Is a people results.
So I stand corrected on what the investment management fee is. It usually typically is about 1%, Meg. Typically, that's what the investment management fees are. I can give you the exact number. I'm not sure off the top of my head.
It changes.
Yeah, the platform fee is usually about 0.3, 0.4%, depending on the value of your capital in the investment. That comes off your capital, yes.
And it's 5 years.
5
5
years,
years.
5-year tranche.
Okay, sorry, I'm going to skip through these. Oh, now I've gone too far. Sorry, we're going back to our investing 101.
And I think we're speeding up because we don't want to keep you here too
Yeah.
long. But I think what would be a miss from us this evening is to potentially talk about offshore. Diversifying your funds and having the opportunity to take some funds offshore. And those that you've been working with us coming to these talks over a period of time, we're of the opinion that at least 30% of your wealth should be diversified and sitting offshore. And the reason for that is to try and peg the value of the buying capacity of your rand. We know that it's depreciated over the years considerably. And what we could buy 20 years ago, 25 years ago, we can't with our rand. So having your funds being diversified and taken offshore, certainly in our opinion, is valuable. We have a couple of ways to do it. I mean, not only are we and this is your slide, Lindsay.
I think just in terms of investing offshore is that, you know, we have our Joburg Stock Exchange. That's where a lot of us invest in. But South African equity represents 1% of the global equity market. So it's also about having opportunities to invest in a different market, getting different returns, having that different exposure. You might have someone who says, oh no, I have to be invested in Apple. Okay, well, let's go offshore. So that's effectively what was the reasoning behind why one would go offshore.
There's different ways to go offshore. Discovery launched a global recurring endowment. We were the first to come in. This is our lump sum slide, as Lindsay is reminding me. And a lump sum is taking money offshore in a lump sum. We can do that either through our single discretionary travel allowance that we're all given, an annual 1 million rand per year that we can take off and that SARB allows us to do. Or we can apply for a tax directive and take more off if we choose to at that point in time. But giving us the opportunity to take funds offshore, and I encourage our investors to look to take some funds off each year using the discretionary allowance. Minimum 25,000 US dollars, 375,000 rands gives you the access to that. And remember that this is now housed within that endowment wrapper that we spoke of. Tax efficient, tax reporting, simplicity. Tax is paid. We're not avoiding that. We can't escape it. However, it's managed at the institution level and it is paid and not a responsibility, an onerous responsibility of reporting your offshore investments in the tax range. Having a beneficiary nomination, not needing to be having an estate and a will and testament tied up in the foreign country, avoiding in some instances some of the citus taxes and estate taxes that can become extremely onerous, also creating potentially capital gains tax problems. So having a share portfolio, having funds in a bank could potentially give you additional administration hassles, and costs, whereas the endowment wrapper is certainly a space for ease of administration.
And can pay out internationally. So as we're leading more global lives, you might have someone that's studying overseas, a child that's studying overseas or living overseas, or your parents live overseas, whatever the case may be. A nice benefit to have there.
And some really nice liquidity options that's there. Discovery have in their true shared value approach a currency enhancer, which essentially is an additional investment that is calculated and put aside running along with your investment, that will pay out at the end of the 5-year or the 10-year term, just giving you the potential volatility that may have of the rand dollar exchange or the rand currency exchange that you're investing in, and just giving you an extra boost, again incentivizing you to use the Discovery solutions compared to our competitors in that space. So very nice, paid out after 10 years, tax-free, and a really nice benefit to consider. We have our recurring global endowment, which is giving the average investor the opportunity to get their funds offshore. And I love this one. I think each and every investor should have it. It's a recurring global endowment, minimum of $200 per month. And what it does is you choose a number, 200, 300, 500, whatever your budget is, and we multiply that by the exchange rate on a given day. And I stand corrected, I think that's the 23rd of the month. And on the 25th, your debit order will run for the exchange rate at that particular point in time. So when the rand is weak, we could be paying a little bit more, but when the rand is strong. So it's giving you that opportunity to get your funds offshore.
And buying in at different times in the market.
I think that's very, very powerful, and a very important point to point out. Thanks, Lindsay, is that when you are investing on a regular basis, you're going in high and low, and you're not then going, is it the right time to take my money offshore? Because every month on the 25th, a debit order runs and the funds go offshore into that inbound investment. So a lovely one for the average investor to be able to start to get some funds offshore.
But who has 300 or 75,000 every month?
No, that's a once-off lump sums.
This is
Recurring is
$200.
$200, yeah.
The lump sum is 375 Rand,
If you want to do a once-off.
but the recurring is $200.
Yeah. We also have access to some global share portfolio funds. So we do believe that it's difficult to have a direct share portfolio because of things like citus tax in the US being up to 40%. So we would rather be investing into what we call a portfolio of funds. And that is also managed by Goldman Sachs as our asset manager there. Yes, love Dahlia.
Sorry.
Still back 2 slides.
Okay.
My apologies. I forgot. I said I'd come back to you. My apologies, Lovely.
This one or the one before?
Lump sum investment to be after paying the 375. Does it have an opportunity for you to be paying monthly over 8?
No.
No. Okay.
No.
So you put in the 375, it sits there for 10 years, and then thereafter they pay.
I think it's important. It doesn't have to sit there for 10 years. It can sit there for a period of time. It could be 3 years, it could be 5 years, it could be 10 years. There are some liquidity issues that we need to deal with in terms of that endowment wrapper. We can access our capital plus a compound growth of 5% per annum in the first 5 years. There are ways that we structure that so that we overcome some of those hurdles and obstacles. So it's not a 10-year plan. It's a plan that is open-ended and available for you when you need it. If you need it before, it's available. If you need it after, it's entirely up to you. If we had another 500,000 to invest, we would open a second contract. So we can take multiple investments offshore. We will not be adding to this contract.
But also the lumps, the global endowments, they actually invest into 100 contracts in one of the investments, which also allows some liquidity within that before the 5-year term.
So the 100 withdrawals in the 10-year.
5 years. An endowment is a 5-year term investment.
It's giving you liquidity.
The first question on the said that there's 100 contracts. But surely there's an admin charge for each additional contract that
No.
you have.
It's a percentage-based fee. It's 1% fee for your one investment. Once it's moved offshore, there are separate contracts entered into after the fact.
Makes sense.
And so back to our global share portfolio funds managed by Goldman Sachs. And like we mentioned, we would prefer being invested into a share portfolio fund rather than a direct share portfolio, obviously from a tax perspective.
And beneficiary.
Mm.
So
many choices
yeah, we
on
mentioned
our global platform. So really, you're not restricted in any way to what type of asset manager you want to use or who you prefer in any which way.
And I had one last question for Tammy, but Lavilia, do you have one before? No. Yes.
So what you said earlier about the global endowment is that I would not have to worry about the tax related matters there. Okay.
Yep, exactly that.
Tax is handled by the administrator.
It's one of the beauties of the actual investment wrapper. So the last question that I had for Tammy, and I think probably we're all thinking about it, sometimes trying to bury our head in the sand.
Hopefully.
I mean, I think the question on everybody's mind at the moment is what is happening in the world? We've had so much noise coming at us, and a lot of it's really concerning. And I know there's nobody who can predict and get it, you know what's coming and what the future has to hold. But what are the experts saying? What are the economists believing? What should we be worrying about with markets and the volatility at the moment?
Yeah, so Shirley, it is very hard to predict going forward. What we all thought possibly at the beginning of the year definitely wasn't. We weren't looking at a possible third world war, nuclear chaos happening either. So, I mean, those sort of events, and as they unfold, those changes, it's really difficult to predict a lot of the things we are able to. All I can say is when we're investing for a certain period of time, and generally it is for a longer period of time. And what we want to do up front is obviously partner and create a strategy with a portfolio of fund managers we believe in, and that they are the ones that are geared towards to navigating us through all of these times. So basically, I mean, we will see volatility. And when you look at volatility, it's almost right now, it seems like, oh, it's happening now. But within 2 weeks, you look again and that volatility is gone. Particularly, I'm going to take a recent example, like in March, when Trump decided to open his mouth and start this trade war tariffs and going out of all the different countries. If you saw the markets reacting, and if you looked at your investments at that point of time, you saw an actual market drop. And you're quite worried, particularly with larger investments. Literally within 2 weeks after that event, your investment was not only back to the original level, but at a higher level. So that actually just talks to more, yes, there is a short-term movement. We are seeing it, but a lot of the things, the fund managers are already predicting certain things, and you'll see a lot of guys have gone a little bit more cautious as well. So having that having the asset class diversification, but also having that fund manager to manage the risk and decide when to go into a lower risk equity type of fund, defensive or not.
Perfect. I guess it's that old adage of time in the market as opposed to timing the market. I think were wise words that were said. And also having the courage to stand the test of time. COVID taught us that. Not panicking and disinvesting and then losing out on the potential recovery, sticking to the long-term goal and plan and partnering. Thank you for your insights. Appreciate it as always. Couldn't do it without you. So thank you so much for those insights. Thank you, Tammy.
Pleasure, Shirley, anytime. Thank you.
And our call to action, I guess, as we come to the end of the evening, is just to say, you know, which of these topics made you think? Was there anything within the investing space that you went, oh, I wish I could know more about? And please do let us know. Book a consultation so we can show you how we can integrate these into your portfolio so that we can empower you how to start, how to get going, how to understand where it is, depending on where you are in your life journey of the investing. And to make sure that we do get some of your wealth offshore so that we look to diversify it. And then to maximize on the boosts and that shared value that Discovery offer. And just to regroup, definitely getting to the end of the evening. You know, some of the boosts that are available, investments on lump sums, you know, our Section 14 transfers, preservation funds, etc. Getting lump sum boosts on that, boosts on our endowments. We give up to a 17.5% boost on our lump sum endowments that we do. Our living annuities, please, if there is anybody in the room who has family, friends in a living annuity, we must be talking, and getting that boost, getting the enhancer, and getting additional money into your investments for being fit, for doing your vitality money, for doing your vitality drive. All of those are just giving you extra little bits of money that are gold nuggets that are going to be available for retirement. But I think on that, we'll just finish off with two specials that Discovery are running at the moment.
Sorry, we've got one. We have a dollar life plan special offer where we've got a premium lock-in. So your dollar premium will be at the exchange rate of 14.9. This was actually ending in the end of June, but they have today told us that it's being extended to September, end of September. So locking in dollar-based life cover that can pay out internationally at a rate of 14.9 Rand to the dollar.
Great opportunity for anybody looking for investments. And I think on that note, we're going to say a thank you to each and everyone for coming. It is a complex topic. I hope we haven't bored the youngsters who are hearing it for the first time. Hopefully there's some insights and some ideas that you can, and for the older people that have been with us for longer, and I say older in terms of service with us and not necessarily in age, we hope it was insightful, and we hope that we've sparked some interest and some thoughts. Thank you to my team once again. Today is financial year end for Discovery. We've worked like absolute crazy, and we want to take the opportunity to thank you for the support, because we wouldn't have had the successful year that we've had without the support. We're truly grateful, and I'm truly grateful for my team. And Skeen is going. No, we didn't mention Simon. We have a new intern that's just coming out of university and going to be joining us on Tuesday in an intern program, getting to know financial advising and the financial services industry and world. And we welcome him. Hopefully he's going to learn lots and add lots of value and spunk to our team. So welcome. And thank you, each and every one of you. Thank you to my team. Please stay, have another bite to eat, another drink if you have the time. And thank you so much. Appreciate it.
Thank you.
And I'm stiff. I shouldn't.